Dear students, welcome to the massive open online course. My name is Dr. Milton Devadayavu, Assistant Professor, Department of Public Administration, Madras Christian College, Chennai. Under Financial Administration, today we are going to discuss such an important topic called fiscal and monetary policies. This fiscal and monetary policies are very basic in the public financial administration. Without understanding this topic, it is very difficult to understand the other topics which is there in the public financial administration. If you are able to understand this topic well, the other topics will be very easier for you to understand in the public financial administration. Okay, just I would like to give you introduction about what is fiscal and monetary policies. Why these policies are considered the important one in public financial administration is this, both the policies, fiscal and monetary policies, which is are macroeconomic policy. What is macroeconomic policy and what is microeconomic policy? See, macroeconomic policy means the policy which is formulated for the whole nation, for the economic development of the nation. If it creates an impact in the economic growth, this is called macroeconomic policy. Then what is micro? Which means if you are formulating a policy for any of the organization or industry which deals the smaller account is considered as a microeconomic policy. See, under this macroeconomic policy, we can divide two categories. One is fiscal and other one is monetary policies. Hope you understood. The fiscal and monetary policies laid down by the government have an impact on the economic environment. See, the fiscal and monetary policies, how this creates impact on economic environment means fiscal policy which is there in the hands of the union government, whereas monetary policy which will be completely takes care of the Central Bank of India. What is Central Bank? Which means Reserve Bank of India. So, based on these two policies, budget which supports to the formulating the budgets, which supports to create the impact on the economic environment. The fiscal and monetary policies have an effect on the supply of money in the economy, credit, changing rates of interest and other related aspects. See, as I mentioned earlier, these two policies are very important in order to which will create impact in the economic environment, because these policies have which deals with economy, credit, rate of interest. If interest rate can go up or it may come down also, and other financial related aspects. Government policies generally coordinated with these policies for ensuring the welfare of economies. See, the objectives of government policy is to bring welfare in the economy of the country. So, this government policies, whenever government frames any policies, they will focus more on the welfare of the society. Likewise, for these policies which focuses more on the welfare of the economies. The Reserve Bank of India controls inflation in the country through fiscal and monetary policies. How inflation can be controlled? Without having sound fiscal and monetary policies, which will not be possible. See, that's why Reserve Bank of India releases every quarter the monetary policy, so that they will create a sound policy in order to control the inflation. So, fiscal policy basically which will be managed by the Ministry of Finance, whereas monetary policy which will be managed and controlled by the Reserve Bank of India. See, if you, for an example, if you take United States, America, which is the central bank of America is federal banking system. Likewise for England, Bank of England. Likewise for India, the central bank of India is called Reserve Bank of India. What is the definition of fiscal policy? Fiscal policy is a financial tool that central banks in regulating the flow of money and the interest rates in an economy. See, here the role of Reserve Bank of India plays very important and vital role while formulating this one. At the same time, as I mentioned earlier, who will take care of this fiscal policy? Reserve Bank of India. The reason being is flow of money and interest rates will be regulated through this fiscal policy. Okay. Now we will move on to how the fiscal, the word called fiscal, which is derived. See, the word fiscal is derived from a Greek word called fisc, F-I-S-C, fisc. What does it mean? The meaning of fisc in the Greek is basket, which symbolizes the treasury of the government. Basically, this fiscal, the word which is derived from the Greek word called fisc, F-I-S-C, which means the meaning of fisc in the Greek is basket. This basket symbolizes the treasury of the government. Fiscal policy is part of the economic policy. See, fiscal policy which is not a separate policy. This fiscal policy, it is part of the economic policy, because see, through which the welfare of the economies will be focused. Fiscal policy is concerned with the country's income and expenditure to achieve sustained rapid economic growth in the economy. Fiscal policy which is focused on income and expenditure of the country. See, why this has to focus on income and expenditure? Both are important. See, the major source of revenue for the government is through taxes. Without knowing my income, if I am planning to prepare expenditure, assume that if you are working for an organization, your salary, if you are getting some 50,000 rupees per month, you know that you will be getting 50,000 rupees every month. Based on that, you will prepare a budget for the forthcoming month, which means for the next month. So, you will plan accordingly, so that the expenditure will not go beyond your revenue, which means your monthly salary. So, you will try to manage all your expenditure within this 50,000. What happen otherwise? If your expenditure goes beyond 50,000 rupees, obviously there will be a inflation. Obviously, what you will do, there will be a deficit. Obviously, you will try to borrow money from your relatives or friends. You will try to pledge your jewel, something like that. So that it is very important to know the revenue as well as the expenditure, income and the expenditure. Fiscal policy focus area is development and growth of an economy. That is why the role, the objective of the fiscal policy is basically development and growth of the economy. Changes in the spending and the tax rates. Okay, sometimes often you would have seen this in the newspaper, there will be increase in the cost of the fuel, petrol or diesel. Likewise, for there will be a increase or decrease in the income tax slabs. So, it is because of the change. Who will decide this change? The finance ministry will decide this change through this fiscal policy. Fiscal policy, it is a tool which will determine the change of the spending and the tax rates. Okay. Fiscal policy includes public borrowing and the deficit financing. These two important components also included in the fiscal policy. Now, we will move on. The other important thing is fiscal policy determines the following. What are those things? First one is about fiscal policy determines the tax revenue. then public expenditure, loans, transfers, debt management, public borrowings and budgetary deficits. All this will be included in the fiscal policy. Without knowing the tax revenue, I cannot prepare a budget. Likewise for public expenditure, likewise for loans and transfers, debt management, public borrowings and budgetary deficit. These are all the things which will be determined by the fiscal policy. Okay. Fiscal policy helps in the fulfillment of the objectives of the monetary policy. Fiscal policy which will also helpful to fulfillment the objectives of the monetary policy. See, it uses the below for the balancing the factors in the economic development. What are all those things? First one is about taxes, public expenditure, debt management. These three things are important in the fiscal policy because these are all the balancing factors in the economic development, because we all know that taxes plays a very vital role in the formulation of the budget, because taxes are considered the major source of revenue for the government. Likewise for expenditure, because union government has to allocate money to the various states and union territories as well as for other welfare measures. So, expenditure will be there. Likewise for public debt will be there. So, these three things are considered balancing factors in the economic development. Fiscal policy also includes the tax policy, investment and disinvestment, debt or surplus management. Apart from this, this also focuses on tax policy, investment and disinvestment of the public sector enterprises or public holdings, then debt or surplus management. If we have excess money, that also is accountable. Okay. Now, we will discuss about what is the objectives of the fiscal policy. First is fiscal policy, first objective is economic development, then efficient allocation of the resources, reduction of inequalities of income, price stability and control of inflation, employment generation, balanced regional development, infrastructure development, capital formation, foreign exchange earnings. We will discuss one by one about these objectives of the fiscal policy. First, we will discuss about economic development. What is economic development according to the fiscal policy? Why it is considered as the one of the important objectives under this fiscal policy is fiscal policy ensure that economic development through mobilizing resources through taxes and savings. Because as I mentioned, if you see the beginning of the session, I mentioned it is important tool for the welfare of the economies, fiscal policy. See, that is why fiscal policy, the primemost objective is for economic development. There will be growth in the economic. So, through mobilizing the resources through taxes and savings, the available resources has to be mobilized through taxes and savings. Second is efficient allocation of resources. Funds will be allocated to the specified areas for the social and economic development. See, still in India there are so many states are required more development. Okay, this fiscal policy what will do is they will try to allocate fund money to the particular areas, particular states, particular field in order to bring development in that particular area. So, that is why special fund which will be allocated to the northeastern region of India. So, because there has to be done so many developmental activities especially in the northeastern region of the India. Okay. Then reduction of inequalities in income. How this can be done? How this reduction can be done in the inequalities of the income, through which how it can be done through appropriation of the tax policies. Okay. Through that only it can be done. How? Through this fiscal policy, appropriation of tax policies can be done. Next one is about price stability and control of inflation. What is price stability and control of inflation? Means the policy implements the methods to control inflation and stabilizes prices. There should be at times this will be done based on the demand and supply. Okay. Inflation and price stabilization has to be done. Otherwise, what will happen is, if I spend 50 rupees to purchase 1 kilograms of rice, because of demand and supply, it may go up or go down. So if it is go down, definitely being a consumer, being a citizen, I definitely it will be very much profitable for me. But this 50 rupees, if it turns to 500 rupees per kg, what will happen? What is the purchasing power capacity of the citizen, whether will I be able to buy that? So that there should be a price stability. Then employment generation. The policy promotes job opportunities and employment generation through the expansion of the infrastructure and other schemes. See, often we are listening this since from our childhood, unemployment and underemployment, how this can be arrested. See, each and every year millions and millions of students are passing out from graduating from the colleges and universities, and out of which only less number of population are getting into job, especially getting into the right job. How this gap can be filled? Through this fiscal policy, the objectives of the fiscal policy, one of the objectives of the fiscal policy is employment generation. This employment generation can be done through having a proper infrastructure facility and other employment schemes. So that if I have a proper infrastructure in my particular state, particular area, I can invite a lot of multinational companies and other companies, so that they can come and launch their enterprises, through which more number of people can be employed. Balanced regional development. This can be done through tax exemptions, cash subsidies lead to balanced regional development. So very important, there should be some balance in the regional development. Sometimes they can provide tax exemption for particular region in order to balance their revenue. Next one is about infrastructure development. See, in the unemployment, through the objectives of fiscal policy, as I mentioned, employment generation, also we discussed about infrastructure development. Here infrastructure development, which is very much needed, because if I have proper road facility, if I have port and proper railway facility, so that I will be able to promote more number of businesses, through which I can provide job opportunity, so that one hand the employment aspect is fulfilled, and the other hand so that which will create revenue to the government. So infrastructure development, don't think that it is just expenditure, we are just spending a money to just lay there the roads. No, but over the period of time, down the line 5 years, 10 years, 20 years, if I have a proper infrastructure facility, especially roads and ports and railways, through which I can make more money, so that I can plan for welfare measures for the state. Then capital formation, it facilitates increase in capital that leads to development of other sectors of the economy, so that through which other sectors of the economy can be developed, so that the capital formation is also to be considered one of the important objectives under fiscal policy. Now we will discuss the next, foreign exchange earnings, through abolition of taxes on export earnings, sales tax, etc., so that which will increase foreign exchange earnings, so which will invite a lot of multinational companies to come to start their business, through which one hand the employment opportunity will be given to the people of the nation, other hand which will create revenue to the nation. Okay, these are all the objectives of fiscal policy. Now we will move on to the types of the fiscal policy. There are two important types. First is expansionary fiscal policy, second is contractionary fiscal policy. What is expansionary fiscal policy? Which means the spending of the government will increase or decrease the revenue. Sometimes, see, there will be government will decide to spend more money, on the other hand sometimes they will try to they decide to spend less money, it based on the revenue. So that sometimes the revenue of the government may go up or it may go down. During pandemic, we all know that what had happened. So that time we have to re-look into all those things. Second is contractionary fiscal policy. The government will decrease their expenditure and increase the revenue. See, it is just opposite. Contractionary fiscal policy means government will try to reduce their expenditure, will try to increase the revenue. Okay, because lack of fund, what they will do is they will try to decrease unwanted or wherever possibilities are there, they will try to decrease their expenditure, whereas they will try to increase their revenue. Sometimes they will change the tax slabs so that through which they can get more money in the treasury of the government. Now we will discuss about instruments of fiscal policy. First is taxation, then expenditure, public debt and deficit financing. These are all instruments of the fiscal policy. See, taxation, taxes are the major source of revenue for any government, not only in India, across the world, any government. So that's why this taxation is considered as such a powerful tool, instrument for the fiscal policy. Second one is expenditure. I cannot say that whatever money I have collected through taxes or profit from the public sector enterprises and other sources, government cannot say that this is a revenue, so that I will just keep this revenue for the future purpose or for it is under the safe custody. No. On the other hand, government has to spend money for other welfare measures. Money has to be distributed to the other states and union territories. Money has to be spent for the other developmental activities in the nation. Okay. So, one hand taxation is the revenue, on the other hand expenditure. There are so various expenditures. So, this expenditure is also considered as the instrument of the fiscal policy, likewise for public debt and deficit financing. So, if there are any deficit when compared to the previous year's revenue and the expenditure, this also has to be considered likewise for the public debt as well. So, that is why these four things are considered the instrument of the fiscal policy. Okay. The Constitution of India provides framework for the fiscal policy. The federal structure of India has divided the power of taxation between center and the state. According to the Constitution, Constitution provides framework for the fiscal policy. See, the country like India, the federal structure, it is divided the taxation power between center as well as the state government, union and the state government. The center transfer funds through finance commission and other means to the states. Through finance commission, the union government transfer the funds to the state governments. The Indian Constitution also provides for the union government to present its annual statement. What is annual statement? It is budget, because our Indian Constitution, nowhere it is mentioned the word called budget. They will mention AFS, annual financial statement only. The taxation and the expenditure which will be incurred in the next fiscal year in the form of budgets, which also prepared by the states. In 2003, the Parliament passed at the central level Fiscal Responsibility and Budget Management Act, FRBM Act, to institute a new fiscal discipline framework. In the year of 2003, they come up with a decision, they are to introduce new fiscal discipline at the central level, that is called Fiscal Responsibility and Budget Management Act. Through this act, the main aim of this act is to introduce transparency in the Indian fiscal management system. What is the objective of FRBM Act? Why FRBM Act to institute a new fiscal discipline is to bring the transparency in the fiscal management system. That is very important, because it is a democratic country. Whatever we do, there should be transparency. But this is short term objective. But what is the long term objective of this FRBM Act? Why? No, I mean, they are decided to come up with to introduce new fiscal discipline framework is, but the long term objective is to achieve fiscal stability and to give RBI the flexibility to deal with inflation. The main objective, long term objective, is to bring fiscal stability. Also to give Reserve Bank of India the flexibility to deal with the inflation. During the inflation, Reserve Bank of India plays a vital role. It was enacted to introduce more equitable distribution of India's debt over the years. The act has been amended several times. After this act was amended several times. On 1st July 2017, the GST, Goods and Service Tax, was introduced and passed an act. We all know that how GST has created a huge impact in the economy of India. So far we had so many amendments. Out of all amendments, this could be considered as the number one, which means such a big amendment in the finance. It is a value added tax, which is a comprehensive indirect tax and the collection of tax on the interstate supply of the goods and service by its central government. Who collects this tax? This tax goes to the central government. From there it comes back to the state government. It is considered as a value added tax. So far we discussed about fiscal policy. Now we will move on to the monetary policy. What is monetary policy? As I mentioned earlier, beginning of the session, these two fiscal and monetary policies are very important, which comes under macro economy of the country. The reason being is which plays a important role in the budget preparation, which plays a important role in the welfare of the economies. So now we will discuss about the monetary policy. What is monetary policy? See, monetary policy deals with money supply, interest rates and availability of the credit. These three things are very important role of monetary policy. First is money supply, second is interest rate and availability of the credit. Who will control this monetary policy? This is laid by the Central Bank of India, which means Reserve Bank of India. Okay. Monetary policy is managed by the Central Bank of the country, which means Reserve Bank of India, who manages the monetary policy. Through this policy, shape the country's economic growth and controls inflation by adjusting money supply and controlling the rate of the interest. See, the objective, the importance of this monetary policy is through which shapes the country's economic growth and controls the inflation. Both are important. Okay. One hand they have to control the inflation, other hand which shapes the growth of the economy. See, next is the monetary policy focus area is stability of an economy. What is stability of economy is, see, one hand based on the demand, supply may increase or decrease. This has to be properly managed. See, the supply and demand is very important in the monetary policy. What is supply and demand in basically? If based on the need, government has to supply the requirements to the people. See, obviously what will happen if there are 100 people living in a particular area, if I have only 10 bags of rice, only 10 rice bags, if I have just 10 rice bags, okay, obviously the demand is more, there are 100 families, but I have only 10 bags of rice, then the demand will increase. So as soon as the demand increases, the rate of the product also will increase. Vice versa, if you see, if I have 100 bags of rice, but where there are only 10 families, what will happen? Demand is less, but I have more number of rice bags. My supply is heavy. Obviously, the rate of the product will go down. The role of Reserve Bank of India is to maintain these two things. If demand increases, supply also has to increase. If demand decreases, supply also will decrease, because these two things will have direct impact on the economy. The role of the Reserve Bank of India is to maintain these two things properly. Then monetary policy target is inflation. Very important role of the monetary policy through Reserve Bank of India. Main target is to focus on the inflation. No political dimension in monetary policy. See, it is very important. Whereas fiscal policy, as I mentioned, it is there in the hands of the government, especially under the Ministry of Finance, where without political interference it is not possible. If they are planning to increase just a 1 rupee of increment in any of the product, let us say the petrol, then there will be a debate in the parliament. Obviously, opposition party members, they raise their voice. See, the fiscal policy, the intervention of the political members the elected members are high, whereas monetary policy you cannot see the political intervention. But the thing is, actually who will be appointed as Governor of Reserve Bank of India? Obviously someone who will recommend by the ruling party only. That indirect impact will be there, but if you see the direct context, so there is no political dimension in the monetary policy. Okay. Through monetary policy, the government or the monetary authority controls the below. First one is supply of money. So they will control how much money can be supplied during this time, supply of money. Second, availability of money. They will ensure that okay, this much of money is readily available if something happens, so that they will try to release the money. Then rate of interest to attain laid down objectives aimed at the economic growth and stability. They will decide the rate of interest. Okay, what is the definition of monetary policy? Monetary policy is the financial tool in managing tax revenues and policies related to expenditure for the benefit of the economy by central government. That is the definition. See here, monetary policy, which is the financial tool, okay, managing the tax revenues and policies related to the expenditure. Why they have to take care of these things? Why it is related to the expenditure is for the benefit of the economy by the central government. So this monetary policy focuses majorly on to bring the benefit of the economy by the central government. Okay. Now we will discuss about what is the objectives of monetary policy. See, economic growth, price stability, exchange rate stability, balance of payments equilibrium, financial stability, inflation target. These are all 6 important objectives under monetary policy. We will discuss one by one. What is economic growth? Through regulating policies and prices and income in the economy, investment is made possible that increases economic growth. See how this can be done? Through regulating prices. There will not be any increase or decrease quite often, so that there will be a stable price should be there, regulating the prices. And income in the economy, that income is also, there should be a proper income to the government through taxes and other sources of income through various sources. Investment is made possible and increase the economic growth, so that through which the investment which may go up, which increases the investment, so that which increases the economic growth. Second is price stability. What is price stability? This can happen through the regulating the value of money. Value of money has to be regulated properly. So through which only price stability can be done. Second is in times of recession, to boost the economy, the interest rates are reduced to avail loans. Friends, this is very important. See, during the recession, what will happen is they will try to reduce the interest rates for the loan. Then what will happen? People will try to avail loan from the banks because the interest rates are gone down. Let us assume the rate of interest is 10%. If they are reducing from 10 to 7%, what will happen? Immediately we will try to avail loan to construct house or to buy cars or other expenditure. So whatever money is being given to the people as a loan, they are supposed to pay capital along with the interest. So this interest will helpful for the government. Likewise, in certain situations, loans are given at the higher interest rates to decrease money supply. See, the first incident, if interest rates have been reduced, there will be more money supply. Okay. But if they are trying to increase the interest rates, if decreases, money supply will be there. If it increases, let us assume from 10% they are trying to increase to 13 or 14 or 15%, what will happen? People will not opt for loan because of the rate of interest is high. That time what will happen is, so that they will try to decrease the money supply. So through which they will try to bring the price stability. Exchange rate stability. it is important to maintain because for the creation of international confidence on trade, through which the exchange rate stability can be done. It is so important to maintain the international confidence on the trade. Instability in exchange rates might lead to undesirable effects such as weakening of the value of currency, speculation and flight of capital abroad. If it is not happen, if the instability will lead towards the decrease of the money value, especially our Indian currency value, which will decrease, which may go down in the international market. Next is balance of payments equilibrium, which means it is a statement of all transactions made between entities is one country and the rate of interest of the world over a defined period. That balance of payment equilibrium, there should be a balance. Okay, transaction between made the entities in one country and the rest of the world for the certain defined period. Then financial stability. See, this financial stability through monetary policy aims to attempts to ensure financial stability in the economy to reduce sudden volatile fluctuation in the financial market and economy. So, there should not be any unexpected fluctuation in the economy. So, the financial stability is very important objectives under the monetary policy. Last one is inflation target. This is also indicated by the monetary policy in India by the Reserve Bank of India Act provides that once in every 5 years the government of India in consultation with the RBI sets an inflation target. So, this is very important. Once in 5 years government of India has to consult with the Reserve Bank of India sets an inflation target. Now, we will discuss about types of monetary policy. There are two types under the monetary policies. First one is expansionary monetary policy. The other name for this expansionary monetary policy is called cheap money policy. Second is contractionary monetary policy. The other name of this contractionary money policy is dear money policy. Now, we will discuss about what is expansionary monetary policy, which means the interest rate will be reduced, money supply will increase, demand will supply. See, as I mentioned in the earlier, so the rate of interest, if it goes down, people they will try to avail more loans so that the money supply will be increased. The second one is about rating. If the interest rates are increased, people will not opt for loan facility, so the money supply will be reduced. Now, we will discuss about instruments of monetary policy. First is bank repo rate, second is reserve repo rate, third is cash reserve ratio, fourth is statutory liquid ratio, then fifth is marginal standing facility, the last one is lending rate. We will discuss one by one. What is bank repo rate? The rate at which the central bank of a country gives loans to the commercial banks in case of shortage of funds is called repo rate or purchase rate. In case of the other commercial banks, if they borrow money from Reserve Bank of India, during that time the rate of interest will be fixed. That is called repo rate. The repo rate is used to control inflation. The main aim of repo rate is to control the inflation. The banks or financial institution approach to the Reserve Bank of India when they face a financial crisis for a loan, and the Reserve Bank of India advances the money at a rate of interest which is a repo rate. Then reserve repo rate. What is reserve repo rate? This rate is at which the RBI borrows money from other commercial banks. Whenever RBI borrows money from other commercial banks, that is called reserve repo rate. It also does this to reduce the excess money supply in the banking system. So, which will try to reduce the excess money supply in the banking system. If commercial bank feels that they have excess money, they can deposit this money into the Reserve Bank of India. So, the money which is borrowed by the Reserve Bank of India from the commercial bank is called reserve repo rate. Why this has to be invested in the Reserve Bank of India means whenever if the commercial bank faces any financial crisis, that time they can borrow the money from the Reserve Bank of India, whatever money they have kept under the safe custody. It is used as a mandatory policy instrument by decreasing or increasing the rate. This reserve repo rate helps in the monetary policy as the instrument either to increase or to decrease the rate. Now we will discuss about cash reserve ratio. What is cash reserve ratio? Means the currency chest is that all commercial bank must keep the minimum amount of money in proportion to their deposit with RBI in cash. This cash reserve ratio, it is applicable for all commercial bank. They are supposed to keep certain amount of money under the custody of the Reserve Bank of India. This minimum ratio of cash to kept with RBI is called cash reserve ratio. Okay, they are advised to keep certain money under the Reserve Bank of India's custody, so that this particular amount is called CRR, cash reserve ratio. This act is another instrument of monetary policy, as a higher CRR, which means cash reserve ratio, will leave a lower amount with the commercial banks to be able to use it for loans and investment. See, these commercial banks further this money, the CRR, whatever money which is kept under the custody of the Reserve Bank of India, can be used as a loans and the investment. Reserve Bank of India also uses CRR to control liquidity in the economy, so that Reserve Bank of India, what they will do is the collected money from the various commercial banks under the CRR, they will utilize this money to control the liquidity in the economy. Okay, now we will discuss about SLR, statutory liquidity ratio. Okay, so before understanding what is SLR, statutory liquidity ratio, we have to now discuss two important things. First is net demand liabilities. What is net demand liability? Means the bank accounts from which one can withdraw sum of money, like a saving or current account, are called net demand liabilities. The money which is withdraw some money like savings or current account, called net demand liabilities. Then we will discuss second is time liabilities. What is time liabilities? See, these are those liabilities or sum of money that the banks are liable to pay to the customers after an agreed period. So, bank are agreed to pay certain amount to the customer after an agreed period. This includes fixed deposit, recurring deposit, cash certificates and so on. Sometimes whatever money we invest as a RD or FD, fixed deposit or recurring deposit. So for this, after the end of the certain period, for an example, let's assume if you invest some 1 lakh rupee as a FD fixed deposit for next 5 years or 10 years, 15 years, after completion of those tenure, government are supposed they should give this money back to the customers. So that this is called time liabilities. It is same thing for RD, recurring deposit, and other cash certificates. See, what is SLR is? The SLR is the ratio of liquid assets to demand and time liabilities, which can be increased by 40% by the Reserve Bank of India. It can be increased up to 40%. It controls the supply of money into the economy by the commercial banks. See, this SLR, statutory liquidity ratio, which controls supply of money into the economy by commercial banks. Now we will discuss about the marginal standing facility, MSF. What is marginal standing facility? What is MSF? See, it is a facility that allows commercial banks to borrow additional overnight money from the Reserve Bank of India by drawing from the SLR, statutory liquidity ratio, at a panel rate of interest. So whenever the banks, commercial banks in need of, they will borrow money from the Reserve Bank of India from the SLR. This makes the banks respond to unexpected liquidity shocks. So that this makes the banks, commercial banks, to respond the unexpected liquidity shocks if they are facing any unexpected liquidity shocks, so that this money can be used. Now we will move on to the lending rate. What is lending rate? See, these are the rates fixed by the Reserve Bank of India based on which money is lent to the customers. Based on which money? which is given to the customers. The higher lending rate, more costly shall be the credit given to the customer. In case rates are lower, the customer can take more credit from the bank. Obviously, if the rate of interest is high, customers will not take more money as a loan. If the rate of interest is less, customers will take more money because the rate of interest is less, so that they will utilize this money for other purposes. Now, we will discuss about what is the difference between these two, fiscal and monetary policies. So far we discussed about what is fiscal policy, what is monetary policy, what is the instruments of fiscal policy, likewise for monetary policies, then objectives of both the policies, fiscal and monetary policies, who controls fiscal policy, who lays down the monetary policy. We have discussed, we had a detailed discussion about these two policies. Now, we have to understand something called what is the basic difference between these two. What is the difference between fiscal and monetary policies? See, both of them are different tools that have an impact on the economic activity of a country. See, these both the policies, fiscal policy and monetary policy, which comes under the macroeconomic policies. The objective is to create impact on the economic activity of the country, welfare of the economies. See, both the policies are totally different, but when it comes to the utmost objectives of this policy is to create an impact of the economic activity of a country. Monetary policies are formed and managed by the central banks of a country, which means Reserve Bank of India, whereas fiscal policy is managed and controlled by the Ministry of the Finance. Monetary policy is concerned with the management of money supply and interest rates in an economy. The major focus area of monetary policy is money supply and interest rate, whereas fiscal policy is managing the aspect of spending and taxation, revenue and the expenditure of the government. Fiscal policy focuses on these two, spending, revenue and the spending. It is a way of stabilizing the economy and helping the growth of economy by the government. See, stabilizing the economy and helping the growth of the economy through fiscal policy. The fiscal policy can be modified by bringing in measures and changes in the tax rates to control the fiscal deficit of the economy if they make some adjustment in the taxes, so that which will create a impact on the tax revenue to the government, so that which controls the fiscal deficit of the economy. Now, we will discuss about the monetary policy processes and framework. See, the process under section 45 ZB of the amended RBI Reserve Bank of India Act of 1934, the Monetary Policy Committee MPC Monetary Policy Committee was constituted by the Union government in the year of 2016 under section of 45 ZB. The committee comprises totally 6 members. See, what is the composition? Who are all those 6 members? Is first the Governor of Reserve Bank of India is a chairperson and ex officio member for the MPC. Deputy Governor of Reserve Bank of India in charge of the monetary policy, who is also member of ex officio. Next is one officer from the Reserve Bank of India to be nominated by the Central Board. He is also member ex officio, and the other 3 members are to be experts in the field of economics, banking or finance or any monetary policy. If the person is expert, so that these 3 members can be nominated from the experts, and they have a term of 4 years unless it is extended. The tenure of the MPC is 4 years. See, the monetary policy framework is evaluating the current and evolving macroeconomic situation. Then second is controlling the conditions of the liquidity to establish market rates of money at or around the repo rate. These are our 2 important framework for the monetary policy. Students, so far we discussed about very important topic in the public financial administration called fiscal and monetary policies. Also, we discussed about the main objectives are of these 2 policies is to bring impact in the economy, welfare of the economies. Also, we discussed about what is the important objectives of fiscal policy as well as monetary policy. What is the role of finance ministry on managing and controlling the fiscal policy, likewise for the role of Reserve Bank of India for the monetary policy. Also, we discussed various aspects of fiscal and monetary policies. We discussed about the difference between these two policies, fiscal and monetary policies. With that, I would like to end this session. Wish you all the very best. Thank you.